Good evening, it's Adil bringing you a review of the price action for the 8th of January 2015 with regards to today's chaotic short squeeze. Okay, that's basically what it's all about. Central bank led short squeeze. Okay, so how do we interpret this? Okay, and what are the reasons for this market to go higher? Okay, so we start off in the morning. Let's just cover the fundamentals like I always do. The Shanghai negative, down minus 40 to 50 points. The Nikkei positive. Okay, actually Shanghai was down more substantially, down 80 points, 2.36. Okay, the Nikkei itself positive, up. Okay, so you had the Nikkei up by 1.6%, and then obviously you had the Shanghai as well. The Shanghai itself was positive as well. So basically, overall, you had the FOMC minutes yesterday. Nothing really untoward other than Mr. Fed Evans' comment with regards to him saying that inflation target was way off, and basically he was being a dove like he always is. So nothing really new there, nothing out of the ordinary. Okay, everybody knows he's a dove. So when a dove, it's like the boy who cried wolf. Okay, everybody knows he's lying. Okay, so and then when he eventually does speak the truth, nobody really cares. So that's the situation that we had there. So nothing new there. Okay, and the FOMC minutes, nothing really that was untoward that I could interpret, and maybe my interpretation is wrong and my understanding is wrong. So as traders, we're always correcting ourselves. If we do misunderstand something and we misjudge something, then we always have to correct ourselves, because once our stop losses are hit, we're forced to obviously correct ourselves, and we go back to the drawing board and we reassess and reanalyze. And yet I've yet to see anything from the FOMC minutes that would allude to any additional or any shift in their stance. So again, it's a work in progress, and I'll continue to read and continue to educate myself with regards to the FOMC minutes. Now, Mr. Leidy has highlighted a graph. Ashraf Leidy, I think you all know him very well. This is the graph that he's highlighted. Let me see if I can share this with you. 1 second. Hopefully, once it loads. 1 second. Here we go. Open image, new tab. Have we got this open? Oh, here we go. Okay, so here we go. So basically, you can see here. He states that the Fed minutes on January 7th, every single time the market has obviously rallied, it's always been post-Fed. Okay, so Mr. Bullard put in the comments with regards to QE4 and the markets rallied. Now, obviously, December the 7th, Fed stays patient. FOMC sticks with extended paid on rates and focuses on low inflation. Minutes spell do away with April hike and refocus on deflation. Now, again, I'm not sure that's the case. I'm not seeing anything with regards to alluding to a potential there for a focus on a deflation. So again, it's really it's how you interpret the FOMC, and from what I understand, according to Kathy Leon, there's no real shift in the Fed minutes pose no threat to Q3, Q4 rate hike trades expectation. So Fed says rate rise is unlikely before April. Who seriously thought it would happen this quickly? Obviously we all didn't, and we all knew it was going to happen in the second half of the year, and that's hence the reason why you can see that the euro obviously is trading down to the 1.17. Sterling is trading down to the 1.50 level. Aussie is trading at 0.81. Kiwi is trading at 0.78, and the reason why that's the case is because strong dollar remains strong. We haven't had a sell-off in the dollar, so the euro hasn't reclaimed 1.19 or 1.2. The Aussie hasn't rallied, the Kiwi hasn't rallied, Sterling hasn't rallied. So if that was the case, if the Fed was remaining was shifting towards a dovish stance and obviously pushing interest rate expectations out further, then surely we'd see a rally in those pairs, and obviously that's not been the case. And obviously USD JPY trade would reverse as well, because the dollar side of the equation wouldn't be as strong, and obviously would start to see a reverse, and that's not the case either. So is the USD JPY move higher? Is that based on the fact that the yen is falling and we have risk on, or is it due to the fact that you have rate high expectations remaining constant, and the dollar is moving higher, and the yen isn't moving lower based on the USD JPY chart? USD JPY chart isn't going higher due to risk on. It's more to do with regards to rate high expectations out of the US and the divergence in the monetary policy between the US and Japan. Okay, so these are all things that we have to take into consideration. Now, if that's the case, if rate high expectations are there, then nothing really has changed. Okay, nothing really has changed. Now we have Brexit fears; they still remain there. Okay, we have concerns with regards to terrorism in France, that still remains there. We had weak retail sales out of Germany today again. Okay, so weak data that neutralized yesterday's strong data. So factory orders out of Germany today were minus 2.4%, and they were expected to come out plus 2.9. So that negated yesterday's bullish employment report. So that was a bearish bias as well. Okay, so that's certainly not the case. Now, the inflation or your producer price index remains stagnant month on month. So no real drop. Retail sales came in more or less in line with expectations in Europe. Okay, so no real drop there. That would obviously strengthen the argument for QE. So I couldn't see any real reason for the markets to rally. Now, according to Forex Live, they've basically put forward three arguments as to why the markets rally today. Year-end, New Year flows are done. Okay, the first and last weeks of the year are often no-go zones for traders and investment managers. A time of the year when flows dominate and moves don't make sense. The dust has settled and traders have settled back into the groove, so that meant putting money back into the market. FOMO, fear of missing out. So obviously people that missed out last year want to get back in again. That's not exactly a logical or an investment trading decision, is it? Just because you've missed out. Okay. Action on economy. US economy is far from perfect, but it's still solid. The ADP numbers on Wednesday were good, and non-farm payrolls won't offer any reasons or for worry. So okay, I understand the obviously the jobs data is strong, but the inflation data isn't picking up, so that obviously doesn't mean anything at all. Real wages are not improving. We've had other data, so ISM and factory orders out of US, and they were very dismal, and that's what led to the sell-off. So this is a real conundrum at present. But the main thing is that the Shanghai obviously closed down quite substantially overnight, so that was negative because they will report that China wouldn't obviously implement a stimulus package that it did in 2008, and obviously that caused the Shanghai market to fall. And the Shanghai generally tends to dictate sentiment, and that obviously wasn't the case today. Also, the markets rallied on some recycled report from Mr. Draghi with regards to QE and so on and so forth. But again, we already know that's been objected by the Bundesbank, and the Germans are totally against it. Okay, especially if you've got a strong unemployment report out of Germany, that's not exactly going to support the case for QE. As long as the Germans are okay and their economy is doing well, they don't really care about the periphery. Okay, so again, adding the fact that you've got terrorism concerns, Brexit concerns. Again, Mr. Syriza had an interview, I think, with Channel 4, and he clearly stated that he wants a 50% debt haircut, and the Germans are not going to abide by that. They will not cut or relief Greece of any debt, and they expect the obligations to be met. So the standoff continues there, and the uncertainty continues there. So weak data, Brexit, obviously terrorism fears, all these concerns from a fundamental backdrop are obviously negative. Now, oil price really hasn't done anything. I mean, it's around the 48. It has popped up now to 49, but that's mainly due to terrorism fears as opposed to global growth obviously moving higher. So again, that's another scenario. USD JPY, Euro JPY, still more or less stagnant. The Aussie and the Kiwi are stagnant. So it was a real conundrum as to why the markets rallied today. It was very, very hard for me to understand, and more of a short squeeze from my perspective. Even though if you are going to argue it was Fed Evans pushing out interest rate expectations, if that was the case, then why didn't the Aussie and the Kiwi rally? Okay, why didn't USD JPY move lower? Okay, think of it from that perspective. Why didn't sterling rally? Why didn't the euro rally? Why did euro continue to fall? So if that's the case, if interest rate expectations and the Fed really is dovish, then why is the dollar still afloat? It doesn't make sense. Okay, logically it doesn't make sense right now. Obviously you get anomalies and divergences in the market, whether it's individuals that think that they can pour money into the market and actually buy the market, and they were the same individuals that are buying the top when the S&P obviously dropped below the 2000 levels. So that's something to consider as well. I mean, we've had a 60-point bounce off once after we've dipped below 2000. So again, it's all does not make sense from a fundamental backdrop, okay, especially with the Shanghai being negative overnight. Again, and then given the fact that you've got terrorism and Brexit phase, very hard to fathom this rally, okay. So now let's look at the fundamental, or should we say the technical and the technical picture now, after I've discussed the fundamentals, okay. So FTSE 100. Right, so we've obviously retraced up to fib 75%. 50 of 75% of the 50 MA will be solid resistance for the FTSE 100. Remember that the fact that we've obviously failed to make higher highs and higher lows, okay. And now this is potentially a lower, could be a lower high, obviously, and this lower high and this is a lower low, and then obviously we potentially come back and settle here. Given the fact that oil obviously is in a precarious situation, there's no real reason for oil prices to start to rally other than terrorism related phase. Until we get solid growth and that gives a footing to the actual market, then that'll be a different scenario altogether, okay. So watch out for the fib 75% resistance on the FTSE 100 at the 50 MA, okay. So that's something that we're going to watch out for, okay. So from a trading perspective, okay. Right, so 50 MA, fib 75% resistance on a daily chart. For FTSE 250, we all know the FTSE 250 is currently into resistance. If we just bring up a chart for you, bear with me. FTSE 250, here we are, we're into horizontal resistance, as you can see here, back into this horizontal resistance zone. So again, that indicates for resistance on the FTSE 100. Now if I bring up the FTSE 350, and hopefully I can give you an insight with regards to the 350, looking at the 350 top 350 stocks, and see exactly where they're trying to take us there. Okay, so use your fib, take it from the pivot high at the 200 MA, take it to the pivot low, we're into that fib 75% resistance again. Use your diagonal trendline resistance to connect it from here to here, and again we are into that potential resistance zone again, okay, with regards to the FTSE 100 and the FTSE 350. So that's very important as to the direction of this market, okay. Now let's have a look at the actual individual sector. So we're looking at the pharmaceutical sector, we're into horizontal resistance on the 60-minute chart. Let's look at the banking sector. Banking sector itself looks as into double top resistance here. Looks more like a bear flag scenario, given the fact that also one of the other big factors with regards to bias being risk off today, it was the Santander news, okay, given the fact that it requires a cash injection, and that obviously has kept the banks at bay. So again, that was another reason for the markets to obviously be jittery, but yet we seem to shake that off, which is quite strange. Okay, oil market, you're in this fib, well, basically in this diagonal trendline resistance, so watch out for that. So that's certainly in the 200 MA, given the fact that oil prices themselves are really staggering. I mean, one of the things that I did mention in yesterday's video was the fact that we needed oil to move and play out the inverted head and shoulders formation in order for the markets to move higher, and that's not been the case. I mean, as you can see here, we've failed really to even trigger or even move on the inverted head and shoulders. And if that's the case, then obviously you know what happens next. I mean, if we fail to move higher on the with regards to this inverted head and shoulders pattern, that's not exactly a bullish pattern. It's not exactly bullish for the markets. With the markets rallying so strong, even without an inverted head and shoulders being played out on oil, it's not exactly a good sign. It means that equities are giving you a false signal. That's basically what that means, especially when the Aussie and Kiwi are not rallying, okay, as well. So be very careful with regards to that, okay. Again, it's a very negative sign given the fact that we've not played out even with such bullish moves on equities. So again, it shows that equities are giving you a false signal, okay. That's basically what it's telling me from an intermarket analysis perspective, okay. So now let's have a look at mobile sector. Obviously we've rallied quite substantially. We are into horizontal resistance now on the mobile sector, okay, mobile telecoms. So again, that argument there for a potential reversal or a move lower. This is the property sector, building, construction and materials, again back into horizontal resistance. So again, we've left an unfilled gap behind as well, so argument there for resistance in the markets to move lower. You have BP into 200 MA, you've got Royal Dutch Shell going into horizontal resistance. So again, these are all arguments for the markets to potentially move lower, okay. The hotel, travel and leisure sector again have been weak, okay. The mining sector was probably the only one really that's shown today. But having said that, obviously gold certainly was under some pressure, okay. But having said that, 60-minute chart is back into horizontal resistance. So again, the mining sector certainly remains under pressure, okay, going into tomorrow's trade. But one of the most important factors was the fact that China was down, and if China's down based on the fact that based on lack of stimulus, that means that obviously the commodities are not going to catch a bid. If the commodities are not catching a bid, then what's causing this market to move higher? Some false recycled paper, or there's some recycled paper on QE, and a false promise of QE from Draghi again. I mean, how many times have you heard that story? But yet the markets continue to short squeeze higher. Very, very strange. Very, very strange. Also, with regards to a recycled speech by Mr. Fed Evans about the inflation target and the Fed members remaining dovish. I mean, when a boy who cries wolf consistently cries wolf, I mean, he certainly loses his potency with regards to the effects in the market. But yet, that's not the case. So Mr. Draghi and Mr. Evans obviously formed a double tag team today, and obviously led the markets quite substantially higher. I mean, you have to take your hat off to it. I mean, it certainly is impressive how central bankers can talk the markets higher, and investors or gullible investors certainly bite the carrot every time. Okay, so 60-minute chart. 6580 will be solid resistance, which, to be honest with you, I'm very surprised we even got to that level. I did expect this resistance level at 6530 to hold, and I was stopped out today quite on numerous occasions. I'm currently minus 120 points for the week, so negative this week from my trading results for my live analysis service. Although my swing trades obviously plus 200 for the week, but currently underwater on my CAC, and I've taken out a new swing short on my FTSE as well. Okay, so horizontal resistance here at 6580 region. My stop loss on my day trade at the moment is currently around the 6590, and obviously you can see here we've got gap fill resistance above at 6535 that we need to close. That's going to be important, and with regards to the markets moving forward. Again, like I said, very, very surprised with regards to the strength in the FTSE. I know it was all based on, obviously you can see from my, from my icon platform, with regards to the FTSE, you can see it was all down to Tesco. Can you see Tesco there? Up 14% alone. But having said that, Marks and Spencer was down 3.5%. So, and Sainsbury's obviously up by 10% as well, quite substantially. Morrison's up by 10% as well. Vodafone up quite substantially as well. So, it certainly looks like the retail sector certainly surged, even though the I mean it's all Tesco related basically. And the rally today was all due to Tesco. Okay, so ideally tomorrow we will need to find and confirm weakness in Tesco, or should we say weakness in retail. So retail, as you can see here, bring up a 10-minute chart. You are into 200 MA. Okay, so 200 MA resistance in the retail sector. So again, that doesn't bode well for the FTSE 100. So we'll see. We'll see exactly what happens tomorrow, but my bias certainly remains bearish. Okay, certainly remains bearish going into tomorrow. Now going into your 60-minute chart, like I said, to your resistance levels are 6580. You have resistance here as well around the 6570 level. That's basically what you're looking at. Okay, from that perspective, let's go to a 10-minute chart, see if I can show you anything on there. Okay, so pivot R3 obviously is around the 6580 level. Very, very surprised we actually got to 6580. I'll be honest with you, I started to short around the 6560 level. I didn't expect us to get to that level that quickly, but we are there and we have to respect that. That's the market. Whether or not our opinions or our analysis it becomes irrelevant, the market is always right. Okay, so horizontal resistance at 6580, which I expect to hold. Very unlikely for the market to blast through that. Very, if it does, very strange going on. But that's the case, that's the situation of, okay, so we have left unfilled gaps behind, so that's obviously not very bullish from a trading perspective. Now let me get rid of all these trend lines because obviously they become redundant now. Realistically, I mean, our job now at the moment, or our focus at the moment, you have an unfilled gap down below and you have an unfilled gap there, so you've got a gap here. Actually, it's no longer a gap, sorry, just this gap here. Okay, so just this gap here at the moment. So I mean, I didn't expect such a gap and go move, and this is quite substantial, but it is what it is, and this is the market, folks. Okay, so we're using our trend line here, connecting our trend line. No good. Okay, so we're basically looking at this and this. Okay, so potential expanding wedge. Okay, so we are looking, from my perspective, I mean, as you already know, my bias is all, I mean, this whole YouTube video at the moment obviously would be biased to a large extent, given the fact that my current inclination or my current active trade is already a bias short. But I do expect to move lower to this 6540 level, obviously potentially break that, then obviously we go back down to 6520, and obviously we've got gap fill on this red trend line as well. So support level 6460, 6490, 6520 and 6540, and then we'll see exactly what happens. But we're definitely looking to test the lower region here on the 6540 level and lower, and then we'll see exactly what happens with regards to the market from then on. Okay, and that's basically where we stand. Unfilled gap left behind, that's not exactly a bullish sign, so certainly take that into consideration as well. Okay folks, so risk on, risk off, wax on, wax off. Goodbye now.